Is anybody bullish enough? A case for the fundamental repricing of gold. Hi everyone and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto and the Gold and Silver Standard. Today welcome back Drew, who's been, well look, that heading alone, you're probably the most bullish guy I know when it comes to gold, particularly silver actually, but when you're saying, are we bullish enough, I'm paying attention. Very excited about this conversation. How are you going today, Drew?
Good, Chris. How are you?
I'm good. Look, it's very interesting when I'm reading through the things that you're talking about here. There's so much going on at the moment to say potentially, even though we think it's going up, maybe we're not bullish enough if there is this repricing that's going on and what that repricing might actually look like. So let's start off today just talking about what you were generally discussing in the article that you wrote recently about this. You've talked about the gold cycle before, you've talked about what's going on in the markets generally at the moment. Just give us that big picture overview because it's fascinating stuff.
Absolutely. So there's a few different factors at play in the gold cycle overall. Just looking at it from a cyclical point of view, gold goes through these 8-year cycles where every 8 years it puts in a significant low. The current cycle started in 2022, so 8 years would bring us up to 2030 with a midpoint in 2026. So we're not even halfway through the 8-year gold macro cycle. Zooming out, we would, looking at the overall landscape, what we would probably expect is two right translated cycles back to back, which means a continued run up well past 2026, followed by consolidation, followed by another more than 4 years run up into the next cycle. There are various reasons for this. One major thing that I look at is overlaying the 8-year gold cycle over the 16-year DXY cycle, so the dollar cycle, the 18.6-year land cycle, and the 80-year socioeconomic cycle. So overlaying the current gold cycle over all of these, long story short, what we're anticipating is a run-up and increase in liquidity, a broad-based systemic financial correction or collapse with the 18.6-year land cycle. But this will happen simultaneously with an 80-year cycle. That 80-year cycle usually will see major systems torn down and new systems rebuilt that will dominate for the next 80 years. And with all of this turbulence on a centennial level, what we'd expect is a once-in-a-century phase of turbulence in most markets. And this is where gold will really shine because investors need an asset that is reliable and consistent and has been around for thousands of years to move from one 80-year cycle to the other. But what's generally been the focus of this article has been the governments and devaluing their currencies against gold to make their debt serviceable. So that's an active strategy that we can see with China and the US, where through increasing the money supply and devaluing against gold rather than other currencies, what they do is they maintain their foreign exchange pairs, prevent massive amounts of outflows, but they reduce the real value of their debt. And the other major factor that's been driving this price increase in gold, and I think that's going to continue driving the macro cycle, the 8-year cycle, this one and the next one, is central banks stockpiling record amounts of gold. They have been stockpiling gold at about 5 times their usual speed since 2022, ever since the US weaponized the US dollar against Russia. So a big part of it is managing their debt. Another major aspect is geopolitical sovereignty as well. Governments want to be able to make moves independent of the approval of the Western world or of America. And China has been pretty clear about its intentions later this decade to move into Taiwan. So they're obviously gearing up for that, and they've learned their lesson seeing what's happened with the US dollar and Russia.
See, I find that really interesting when you bring those two worlds together because you talk about these cycles, which are very much a sort of technical analysis type way of looking at the world. You're looking at charts, you're looking at persistent patterns that happen over time. And then you talk about what central banks are currently doing, which seem to be independent, right? Like you seem to go, well, they're stockpiling because they're worried about the impact potentially of weaponization of the US dollar, those sort of issues. But both things feed into each other here. It's really quite interesting to see the interplay between these fundamental factors that seem like they have nothing to do with the underlying cycle theory that you're talking about, but they just keep playing out time and time again.
Yeah, the interplay is super interesting because some people will say that these events are what is driving the cycle and these events are driving the price. But the cycles work out from a timing perspective so perfectly over and over again over centuries that to me it almost seems like the cycles play out because of the laws of nature. And these narratives around what people think are actually driving the price just attach themselves to the cycle. Now, of course, central banks stockpiling gold at record pace is going to increase the demand and create a supply shortage, and that will drive the price up. But it's happening at this phase of the cycle because there are so many factors at play. Pinning things down to one specific factor makes things really difficult to observe. But when you look at these cycles, why are central banks stockpiling? Because we've moved from a globalized environment to more of a sovereign environment where nations are no longer cooperating like they used to. There's socioeconomic reasons for this. There are geopolitical reasons for this. And all these different factors playing into one another tend to work together to just push this cycle forward in a very interesting way that it's just the same timing going over and over again. So I tend to focus on cycles and I use narratives to validate where we are in the cycle rather than focusing on narratives and just trying to see how something's going to affect another thing because, like I said, there's just too many different factors at play.
And that's what really, I'm a bit torn when I think about this one angle I want to ask you about, which is what is going on here with the paper holdings, because this is something that has got a lot of attention recently, and I'm very conscious of thinking of it through that narrative lens to go, well, yes, because we've been talking about this for a long time, that you talk about these derivative products where there are many paper claims to each physical ounce that's held, and now we've seen that there's been lots of movement of the physical metals. There's been some stresses on those markets that have shown up in funding rates and things like that. So I'm really interested in your perspective on this because I'm always trying to not get sucked into the narrative, because every time people say, when this goes, it's going to be a big problem. When this goes, it's going to be a big problem. And then it sorts itself out, it solves itself. But in the back of my mind, it is going to happen one day. It is going to happen that more people are going to want their physical out of those vaults than the amount that exists, and it's going to blow up that derivatives market. Against the backdrop of what you're talking about when you talk about these cycles, you probably are in the best position of really anyone I've spoken to on this to be able to give us timing around some of this, because it could play out very much like that. But do you have that missing piece there where you've got a bit of an idea of when the timing of that might be?
Timing these things, I think, is incredibly difficult. There's a few points on that. So we have seen this issue with paper markets in the past, where the markets essentially enter backwardation, where a futures contract is cheaper than getting physical delivery today. Normally, a futures contract will be more expensive because there's the carry cost of storage and holding it, and the cost of actually getting delivery down the track is borne by the contract provider. So that is a healthy market, a market that has trust in it, a market that has sufficient supply. But when you start looking at supply shortages and people saying, no, I want physical delivery today, and that goes out of whack, what happens is a futures contract will actually be cheaper because there's more demand for physical delivery today. And we've seen that happen over the last couple of weeks, where there's just a massive supply shortage in the London vaults. huge delays in delivery for people getting access to their physical metals from the Bank of England. And digging a little bit under the hood, what sort of shows you that there's a big issue is the lending rates spiking. Now, the way these supply issues get sorted out generally is through people borrowing physical gold or physical metals in the short term to patch over the supply issues and the lack of the increased demand and the lack of supply. And that has spiked to unprecedented levels. So if there was to be some sort of breakdown in this derivative market, now is closer to anything that I've seen from what I've observed. Now, I'm not saying that it's going to happen straight away, but we're starting to see the cracks in the derivative markets get bigger and bigger. Looking at the ratio between contracts versus physical, clearly there's something wrong there. There's a massive multiple of contracts, paper gold versus physical gold. So there's obviously rehypothecation that's gone a little bit too extreme on that side of things. Now, in terms of when this happens, like I said, I don't know, but any human-made system will eventually break and will eventually collapse. Gold and silver as a physical commodity is God-given, and that's why holding physical metals is eternal, but holding paper contracts at some point on a long enough time frame will collapse. So when that happens, who knows? But we're observing some really interesting movements in the derivative markets this month. So we'll keep an eye on things over there, and I've seen enough of these to know that they generally get patched over, but this is probably the worst one that we've seen so far.
So one follow-up on that. What happens if we don't know, this is the Elon Musk angle, right? Like, we don't know the Elon-Trump combination. They want to devalue potentially their currency against gold, so a one-time revaluation of gold. In that scenario that you've just described, where it's really those derivatives markets are teetering on the brink potentially of danger, does something like that, could that be the thing that pushes it over the edge? Does that make sense to you? Like, that's what I'm wondering.
Look, it certainly could be what pushes it over the edge. In terms of revaluing gold, that is something that is a gradual process and has been clearly being adopted by major governments around the world to make their debt more serviceable. Generally, with the derivative markets, if the price shoots up way too quickly, yes, it will cause an issue. It will cause a collapse. In terms of using futures markets to, in the short term, control the price of an asset, the main concern that these paper contracts, the issuers of these paper contracts have, is the price not rising too quickly. It's not that they don't want the price to rise, they just don't want it to rise too quickly, because then they're really going to be scrambling. So I don't personally think that the US is going to revalue gold overnight. And I call me a pessimist, but any audit of Fort Knox, I personally don't think the people that we're looking at to come and save us are the people that are necessarily the enemies of the powers that be. I wouldn't trust any audit of Fort Knox, even if it was redone today. I think in fact it's a perfect opportunity to go in there and say, oh yeah, look, it's all there. And then for all the mistrust to vanish, where they're like, oh, look, we trust these people. So I'm pretty sure everyone works for the same people. And in order to Fort Knox will probably end up being a non-event. And I think gold being revalued against the US dollar is happening, and it will continue to happen to make the government debt serviceable. But I don't see an overnight spike based on the Fort Knox audit.
That's a much more probably logical and sensible answer than maybe what I was hoping for, because you see the potential here that we're going into Fort Knox, there's nothing there, or you see the potential we're revaluing gold to $3,500 an ounce overnight. But what you're saying probably makes a bit more sense, right? That these things are actually happening, and that's what actually catches everyone out, because they're expecting the big headline and the big boom in the market, but it might not play out that way. It might just naturally unfold that we get the same outcome, but it didn't happen the way that, in the sensational way that everyone was expecting.
Exactly. It'll be, I think it'll be steady and boring enough for most people to actually miss out on it.
And this will be my final question, really, to wrap it up along that line of thinking. The steady, boring angle, the gold market in particular, hasn't really attracted the level of attention you would think, given that we've been hitting all-time high after all-time high. Maybe we're starting to get a little bit of that now, with the focus being brought on Fort Knox and different things that make people start to think about gold. But I know, obviously, you have a bias on this. I have a bias on this, to thinking that everyone needs to have some gold in their possession, right? That's fundamentally what we believe. But do you think that there is something to say for now being a time to accumulate for people who potentially have a little bit, maybe not enough, or because, I mean, that was the article, right? Are we bullish enough? Because I'm starting to think that maybe it is still the time, because we don't have that extreme sentiment in the market that everyone's rushing to get it, apart from central banks and governments, which is telling us a story on itself. But yeah, what's your view on that? Is now potentially the time, with those risks that you've described, and pairing that with the fact that not everyone is in a full-on capitulation, sort of bullish blow-off top type scenario yet?
100%. So there's two types of investors that I'm seeing at the moment in gold. They're the ones that are already clued into the value proposition, who have been looking at recent price increases in the short term and saying, oh, look, it's gone up. Maybe I'll wait for it to pull back a little bit. Feels a bit expensive now. And so maybe I'm just going to wait. And to them, I would say, well, we're really early in the macro cycle. It's a very long-term investment anyway. Gold, it's not something that you buy today and sell next month. And when you're looking at long-term cycles, you really need to zoom out. Seeing minor price increases for 10, 20% over a couple of years and thinking that you've missed the boat, really when you zoom out to look at the single decade or multi-decade peak chart, you're still extremely early. I know people that were looking at spot gold at about 2,000 US an ounce, and we're thinking, oh, it's gone up a little bit, maybe I'll wait, and then we just bought a little bit, and then are now buying more, thinking, oh, I should have just pulled the trigger back then. So because it's a long-term investment, I would generally say zoom out. Don't worry about short-term price movements over the next month or two. Get your long-term allocations in place, because we're still early, objectively speaking, in the macro cycle. To the other side of investors who are simply not paying attention because it's not a blow-off top, it's not hyped up enough, and they're looking at other asset classes that are more appealing in terms of high-risk plays like tech stocks and AI stocks and things like that. They're probably not watching this, but to them, I would generally say, again, a similar message of zooming out, because if you look at where we are in the macro cycle, we will expect another phase of liquidity increase, complacency increase, and a blow-off top across most assets. But what comes into that is potentially a decade of sideways chop for risk assets and stocks, more than likely multiple years of decrease in land value, most other assets struggling. And in this phase, gold and silver do really well. So you'd see gold and silver increase in the complacency phase where liquidity is increasing, but then really continue to shine in the phase that follows, which is the recovery phase, while other assets struggle. So again, to them, I would say take a long-term view, take the, like you said, slow and steady and boring view. And then when you look back in 10 years, you've probably outperformed most people just because you took a really zoomed out approach to your investing. So it's the same advice really to both. Zoom out, make decisions for the next decade or multiple decades, and that'll help you sleep easy at night as well.
Really thoughtful advice, I think, and it really pulls in everything that you've been saying. Look, always love these conversations, particularly with big headlines like, are we bullish enough? there's so much in there. It's really valuable. I think everyone will appreciate being able to dig into that today. So thank you so much for your work on that, Drew.
No worries, Chris. Good to chat to you.
Good to chat to you. Thanks everyone for watching. We'll chat again soon.